This is not just another mining headline, this is not just a stock pop, and this is definitely not just about rare earths. A $1.6 billion metals deal tied to Trump-era strategic policy has just reignited the U.S. rare earth supply chain, and one company is at the center of it. Today, I'll break down what just happened, why the market is reacting violently, and what this means for your money, your retirement, and America's economic survival. Stay with me, because this story connects geopolitics, currency power, and the next commodity supercycle. I'm recording this on Wednesday, January 28th, just after 12 p.m. here in New York. Let me know in the comments what time you're watching. I'm always curious who's here, live with the moment, and who's catching this later. And one quick note before we move on, the data shows a large number of you watch these macro breakdowns regularly but haven't subscribed yet. If you're getting value from this perspective, hitting subscribe really helps support the channel more than you might realize. What just broke is not a random press release or another speculative mining headline. It's a signal flare from the US government that something fundamental has shifted. A $1.6 billion strategic metals deal tied directly to Trump-era industrial policy has resurfaced, and markets are reacting because they understand what most headlines won't say out loud. This is about control. Control of supply chains, control of strategic materials, and ultimately control of national survival in an increasingly fragmented global system. Rare earth elements sit at the center of modern power, yet most Americans don't realize how exposed the United States truly is. Despite the name, rare earths aren't scarce in the ground. What's scarce is the ability to process, refine, and separate them at scale. For decades, the U.S. allowed this entire industrial ecosystem to migrate overseas, primarily to China, in exchange for cheaper inputs and higher short-term corporate margins. That trade-off worked until geopolitics replaced globalization. China now dominates roughly 80 to 90% of rare earth processing capacity. That means the U.S. military, its energy infrastructure, its electric vehicle supply chains, and even its consumer electronics rely on materials refined by a strategic competitor. This is not a hypothetical vulnerability. China has already restricted exports in the past, and each time it does, Washington panics quietly while markets pretend nothing is wrong. This deal is a response to that panic. The $1.6 billion figure matters less than the intent behind it. This isn't venture capital chasing returns. This is sovereign capital chasing security. When government-backed money enters a sector, it's not looking for a quick flip. It's locking in access for decades. That changes everything. It reduces financing risk, guarantees demand, and turns previously marginal projects into nationally protected assets. Investors understand this instinctively, which is why the reaction was immediate and violent. The Trump-era origin of this deal is also critical. Regardless of political alignment, Trump's economic doctrine centered on reshoring strategic industries, rejecting dependence on hostile supply chains, and weaponizing tariffs and industrial policy as tools of national defense. This deal fits perfectly into that framework. What we're seeing now is not a reversal or a new idea. It's the continuation of a policy path that never actually stopped, only went quieter. Markets don't move on ideology. They move on inevitability. The inevitability here is that the United States cannot function as a modern military or technological power without secure access to rare earths. Every advanced weapon system, every AI-driven platform, every grid-scale battery system depends on these materials. That makes rare earths less like copper and more like oil in the early 20th century, a foundational input that determines who leads and who follows. This is why the phrase strategic metals is doing so much heavy lifting. Strategic means non-negotiable. It means price is secondary to availability. It means the government is willing to subsidize inefficiency in exchange for independence. And once that threshold is crossed, the entire valuation framework changes. Assets that were once judged on profitability are now judged on necessity. What just broke, therefore, is the illusion that rare earths are a niche investment story. They've officially entered the realm of national priority. When that happens, capital doesn't ask permission. It reallocates. That's the move you're witnessing right now, and it's only the opening act. USA rare earth is not exploding because of hype, momentum traders, or social media chatter. It's exploding because the market understands one core truth. When government-aligned capital enters a strategic sector, the rules of valuation change overnight. This move is not emotional, it's structural. Investors are repricing risk, time horizons, and political backing all at once. And that repricing happens fast because the window to front-run policy is always short. In normal markets, companies rise or fall based on earnings projections, production timelines, and balance sheet strength. But strategic metals do not live in a normal market. They operate in a parallel system where supply security overrides profitability and where demand is not driven by consumers but by governments and defense planners. Once a company is perceived as being aligned with that system, it effectively exits the speculative category and enters the strategic one. That transition is exactly what the market is signaling with USA Rare Earth. The key catalyst is not just the size of the $1.6 billion deal, but what it implies about future demand certainty. Government-linked agreements don't function like commercial contracts. They imply long-term offtake, preferential treatment, and in many cases, implicit backstopping during downturns. That dramatically lowers the downside risk profile of the company. When downside collapses, upside expands, and valuations stretch far beyond what traditional metrics would justify. This is why charts move vertically when policy enters the equation. Another reason for the explosion is scarcity, not of rare earths themselves, but of viable US-based players. The investable universe of American rare earth companies is extremely small. That creates a funnel effect. When institutional capital decides it needs exposure to domestic rare earth production, it has very few doors to knock on. Capital doesn't trickle in under those conditions, it rushes in. That urgency shows up as explosive price action because supply of shares cannot expand fast enough to meet demand. There is also a signaling effect at work. Markets are forward-looking machines, and they don't wait for contracts to be finalized or facilities to be built. They price in trajectory. This deal tells investors that permitting hurdles will soften, financing will loosen, and political resistance will evaporate for projects deemed strategically essential. In other words, obstacles that once suppressed valuations are now expected to disappear. That expectation alone is enough to justify a major re-rating. Critically, this move is not about current production levels, it's about optionality. USA Rare Earth represents a call option on America's industrial reawakening. If rare earths become a choke point in future geopolitical conflicts, domestic producers move from nice to have to must have. At that point, cost structures, timelines, and even environmental constraints become secondary considerations. The market is paying up for that optionality because history shows that strategic assets are always revalued during periods of tension. The final accelerant is credibility. For years, rare earth independence was discussed as an abstract goal with no real follow-through. This deal changes that perception. It suggests coordination between policymakers, defense interests, and capital markets. Once credibility is established, capital flows multiply. Funds that were previously prohibited from speculative exposure suddenly have justification to enter, because the risk profile has fundamentally changed. That creates a second and third wave of buying that extends well beyond the initial headline reaction. So when you see USA Rare Earth explode, you're not watching a stock story. You're watching capital reposition in real time in response to a shift in national priorities. This is how markets behave when something moves from optional to essential. And historically, those moves are not short-lived. This is not about green energy, ESG narratives, or electric vehicle marketing campaigns. Those stories are convenient, politically acceptable wrappers, but they are not the real driver. Rare earths sit at the heart of modern warfare, and every major power understands that future conflicts will be decided as much by materials access as by manpower. When the United States moves aggressively to secure rare earth supply, it is preparing for a world where supply chains are weapons. Modern military systems are no longer steel and oil machines. They are sensor-driven, data-heavy platforms that rely on highly specialized materials. Rare earth elements are embedded in missile guidance systems, advanced radar arrays, satellite communications, stealth coatings, and electronic warfare technology. Without reliable access to these materials, advanced weapons degrade into expensive metal shells. That reality keeps defense planners awake at night, and it's why this deal exists in the first place. China's dominance over rare earth processing is not an accident of economics. It was a deliberate strategic decision made decades ago. While Western nations outsourced refining due to environmental and cost concerns, China absorbed the pollution, built the infrastructure, and consolidated control. Today, it holds leverage that is difficult to overstate. In a conflict scenario, even partial export restrictions could cripple Western defense production. The US knows this, and so do its adversaries. This deal represents a quiet acknowledgement that economic interdependence has limits. The post-Cold War assumption that trade would neutralize conflict has failed. Instead, trade has become a tool of coercion. Rare earths are among the most potent tools available because they sit upstream of almost every advanced technology. Control the inputs, and you influence the outcome long before a shot is fired. The reason markets are responding so forcefully is because war economics are different from peace economics. In wartime or pre-war conditions, efficiency no longer matters. Redundancy becomes a virtue. Governments willingly overpay, subsidize, and stockpile because the cost of shortage is catastrophic. Once an asset enters that category, its value is anchored not to margins, but to strategic necessity. That shift is what investors are recognizing now. It's also why the green energy narrative is misleading. Yes, rare earths are used in wind turbines and electric motors, but those applications are secondary in priority. If supply becomes constrained, civilian uses will be sacrificed first. Military demand always clears the market. That reality ensures long-term demand regardless of consumer trends or political cycles. Investors who understand this are not betting on EV adoption curves. They're betting on geopolitical inevitability. There is historical precedent for this dynamic. Oil was once treated as a commercial commodity until global conflict turned it into a strategic weapon. Nations that controlled oil flows dictated the tempo of war and post-war reconstruction. Rare earths are following the same trajectory, but in a more technologically complex form. They are the oil of the digital battlefield, and whoever controls them controls the pace of innovation and defense readiness. This deal is therefore less about immediate supply and more about signaling resolve. It tells allies that the US is serious about rebuilding strategic autonomy, and it tells rivals that material choke points will no longer be tolerated. That signal matters because deterrence begins long before troops mobilize. It begins with supply chains. When you strip away the marketing language, this is about preparing for a more hostile world. Markets may not say it out loud, but they price it in ruthlessly. Rare earths are no longer just inputs, they are leverage. And leverage in geopolitics is everything. Headlines are designed to grab attention, not to explain capital flows. They focus on personalities, politics, and price spikes, while the real story unfolds quietly in the behavior of large, patient money. To understand what's happening with USA Rare Earth and this $1.6 billion metals deal, you have to ignore the surface narrative and follow where capital is repositioning itself. Markets are not reacting to news, they are reacting to alignment. Institutional investors don't chase trends the way retail does. They move when the probability landscape changes. This deal represents a shift in probabilities, specifically the probability that domestic rare earth production will be protected, subsidized, and prioritized by the US government over the long term. Once that probability crosses a certain threshold, capital is compelled to move, even if valuations appear stretched. Missing a structural shift is far more dangerous than overpaying early. What makes policy-driven moves so powerful is that they compress time. In normal cycles, industries evolve slowly. Permits, infrastructure, and capital formation take years. Policy short-circuits that timeline. When the state decides something is essential, obstacles that once took a decade to clear can disappear in a year. Investors are not buying today's reality. They are buying the speed at which tomorrow's reality is being pulled forward. This is also why traditional valuation metrics fail in moments like this. Price-to-earnings ratios, discounted cash flow models, and production forecasts assume stable rules. But the rules are changing. When a sector becomes strategically important, the government implicitly becomes a buyer of last resort. That backstop alters risk in a way spreadsheets can't easily capture. Capital recognizes this intuitively, even when analysts struggle to justify it in reports. Another layer to this shift is the growing distrust of paper promises. Financial markets are saturated with claims, future earnings, future growth, future innovation. But in an era of rising debt, geopolitical fragmentation, and supply chain fragility, investors are increasingly drawn to things that are tangible and difficult to replicate. Physical materials with strategic value stand out in that environment. They represent optionality that paper assets cannot provide. We've seen this pattern before. In the 1970s, oil was revalued not because demand surged overnight, but because geopolitical risk exposed supply vulnerability. After the collapse of the Bretton Woods system, gold was repriced as trust in fiat currencies eroded. In the early 2000s, energy and raw materials surged as globalization strained capacity. Each time, the catalyst was not consumption, but insecurity. Rare earths fit that historical template almost perfectly. What's different now is speed and transparency. Capital moves faster, and information spreads instantly. When a strategic signal is sent, the reallocation happens in days, not years. Funds that manage trillions cannot afford to wait for confirmation when the downside of being late is existential underperformance. They move when the signal is clear, not when the story is comfortable. This is why focusing on headlines misses the point. The real confirmation is in where money is willing to commit long term. USA Rare Earth is attracting attention not because it's fashionable, but because it sits at the intersection of policy, scarcity, and physical necessity. That intersection is where durable capital parks itself when uncertainty rises. Following the real money means understanding incentives, not narratives. Governments want security. Institutions want protection against systemic risk. Strategic metals satisfy both. Once you see that alignment, the price action stops looking irrational and starts looking inevitable. What this means for you depends less on whether you trade individual stocks and more on how exposed your financial life is to a system that is quietly changing underneath you. For decades, the standard playbook worked. Hold cash, own index funds, trust bonds, and assume stability. That playbook was built for a world of expanding globalization, cheap energy, and predictable monetary policy. The signals coming from this rare earth deal suggest that world is fading. When governments begin prioritizing physical inputs over financial efficiency, inflation stops being a temporary inconvenience and becomes a structural feature. Strategic materials don't obey the same supply dynamics as consumer goods. You can't instantly ramp production, and you can't substitute them easily. That means prices don't just rise, they reset. For individuals, this translates into a slow erosion of purchasing power that doesn't show up immediately but compounds over time. This is where asset exposure matters. Cash feels safe, but it is the most vulnerable asset in an environment where governments are willing to spend aggressively to secure resources. Bonds rely on the assumption that inflation can be controlled without breaking the system. Index funds assume that broad corporate profitability will continue uninterrupted. None of those assumptions are guaranteed when supply chains are being reshored at higher cost and geopolitical risk is increasing. Strategic assets change that equation. They sit outside the financial system while still benefiting from it. Materials that are essential, scarce, and politically protected tend to hold value when confidence in paper claims weakens. This doesn't mean abandoning traditional investments, but it does mean recognizing concentration risk. A portfolio built entirely on financial assets is implicitly betting that the current system remains stable. History suggests that's a dangerous assumption. There is also a timing element that matters. You don't need to predict the exact outcome of geopolitical tensions to understand direction. The movement toward national stockpiling, industrial policy, and supply chain security is already underway. Waiting for clarity usually means paying a higher price. The market rewards those who position early, not those who react once the story becomes consensus. Psychologically, this shift can be uncomfortable because it challenges narratives people have relied on for years. But markets don't care about comfort. They respond to incentives and constraints. The incentive for governments is to secure materials at almost any cost. The constraint for individuals is that their savings must survive in that environment. Aligning with reality is not pessimism, it's adaptation. Ultimately, this moment is less about chasing opportunity and more about reducing vulnerability. Understanding what this deal represents allows you to ask better questions about your own exposure. In a world where physical assets are regaining strategic importance, ignoring that trend is a choice, and it's not a neutral one. This deal is not an isolated event, and it shouldn't be viewed through the narrow lens of a single company or sector. It is part of a much larger structural realignment that has been building quietly for years and is now accelerating. The global system that dominated the post-Cold War era was built on trust in financial instruments, open trade, and the assumption that efficiency would always outweigh security. That assumption is breaking down in real time. Across the world, governments are rethinking what truly matters in a crisis. The answer is no longer financial leverage or abstract economic growth. It is control over essentials. Energy, food, metals, and manufacturing capacity are being reassessed as matters of national survival. When nations begin stockpiling and subsidizing physical goods, it signals a loss of confidence in the old model. Paper claims work until they don't. Physical control works when everything else fails. This shift is also inseparable from the mounting strain on the global monetary system. High debt levels, persistent deficits, and repeated monetary interventions have weakened trust in fiat currencies. While official narratives insist stability can be maintained indefinitely, actions tell a different story. Nations are acting as if future purchasing power is uncertain, and they are converting financial capital into tangible assets that cannot be diluted or defaulted on. Reindustrialization is the natural consequence of that mindset. It is not about nostalgia or political branding, it is about resilience. Producing critical materials domestically is more expensive, slower, and less efficient in the short term. But in a fragmented world, resilience is more valuable than efficiency. That trade-off defines the next economic cycle, and it is already reshaping capital flows. What makes this moment especially important is that the transition is happening before a visible crisis forces it. Historically, these shifts only occur after catastrophic disruption. Today, governments are attempting to front-run the pain, knowing that once supply chains fracture completely, rebuilding them becomes nearly impossible. That urgency is why deals like this are being made now, not later. For markets, this represents a reordering of priorities. Growth at any cost is being replaced by durability at any cost. Assets tied to physical reality, strategic necessity, and political protection are moving up the hierarchy. Financial abstractions that depend on perpetual stability are moving down. This doesn't mean collapse is imminent, but it does mean the rules are changing. The bigger picture is that we are entering a world where material constraints matter again. The idea that technology alone could overcome scarcity is being tested by geopolitical friction and resource concentration. In that world, value flows toward what is essential and defensible. This deal is one signal among many, but it is a clear one. It marks a transition from an era of paper confidence to an era of physical priority. Understanding that shift is not about predicting disaster, it's about recognizing direction, and direction, more than timing, is what determines who adapts and who gets left behind.